Okay, everybody, good morning. So we wrapped up chapter 7. We had the group project, and now we're moving on to chapter 8, which is about receivables. And we're going to talk about a couple different kinds of receivables. In general, receivables are all money claims against other entities, including people, companies, and organizations. Accounts or trade receivables result from sales on account. Okay, and then notes receivable are amounts that customers owe for which a formal written credit instrument has been written. You guys have probably already made this entry many times, but to record receivables, it's a debit to accounts receivable and a credit to sales. Now, if you're recording a notes receivable, it would usually be a debit to notes receivable. And usually a credit to cash. Sometimes it can be sales and sometimes it can be accounts receivable. You'd use cash if you were making a loan. Sales would be if you're selling with a long-term payment. You're allowing them some additional time versus usual accounts receivable. And then accounts receivable would be when they fail to pay their account on time, you would change it to a notes receivable because the note allows you to collect interest on that debt. Okay, there are two methods for uncollectible receivables as follows. And you have the direct write-off method, and this records bad debts expense when an account is determined to be worthless. or uncollectible. Make a little note, this is non-GAAP. And then the allowance method records bad debts expense by estimating uncollectible accounts at the end of the period. So the direct write-off method, I put that paragraph in there for you. If accounts receivable is not material, which means that accounts receivable is small relative to the rest of the business, then companies can use the direct write-off method even though it's non-GAAP. Because the argument is that it's so small that my investors won't care. And so whenever they're notified or they realize that the amount is uncollectible, usually, by the way, you get it because you get something from the bankruptcy court that says, you know, this customer is not going to be able to pay. And that's how you know that there's going to be an issue. And so in order to write off an account there, you would debit bad debts expense and you would credit accounts receivable. And they usually put like a customer's name on there. You know, it depends on how your accounts are tracked. And that takes that off the books. If the company pays all or some of the debt after being written off, then the account has to be reinstated. So you would debit accounts receivable. You would credit bad debts expense, reversing that entry. And then to record the payment, debit cash, and then credit accounts receivable. Sometimes in bankruptcy settlements, you'll have customers that come back and able to pay some of it. And so you would record it like that. Okay. Now moving on to example 1. So this company applies the direct write-off method. So we have to prepare the journal entries. So it says Dexter determines that it cannot collect 45,000 of its accounts receivable from customer Lester. So on the 11th, we're going to record bad debts expense. And that's for 45,000. And we're going to credit accounts receivable Lester for 45,000. So it unexpectedly pays its account in full on the 29th. So we have to reverse this. So we have accounts receivable Lester for 45,000 and a credit to bad debts expense for 45,000. Then you'd have second part of that entry, debit to cash for 45,000 and a credit to accounts receivable Lester for 45,000. After you finish that one, you have a practice. I'll give you a couple minutes to record that entry. If you have any questions, please give me a wave and I'll be happy to come around and help answer. Okay, so hopefully you're able to do this one. You have the date at first, and you're going to debit bad debts expense, and it's for 50,000. And you're going to credit accounts receivable. In this case, I think it was more, or 50,000. Any questions on the direct write-off method? Okay, so now we're going to move on to the methods that are approved by GAAP. And the first one we're going to talk about is our part of the allowance method is your percentage of sales. And so it should be reported on net sales at the end of the period. Remember, net sales equals sales less sales discounts and sales returns and allowances. And what you do is you take the total net sales and multiply by the estimated percentage of bad debts. And note that this method may use total net credit sales or total net sales. And so the entry would be a debit to bad debts expense and a credit to allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset account. And is shown netted with accounts receivable. So you'll have accounts receivable, and usually they'll say net. And that'll be accounts receivable minus the allowance. Note here, companies will have a debit balance in accounts receivable and a normal balance in allowance for doubtful accounts will have a credit balance. However, the allowance for doubtful accounts can have a debit balance if companies do not estimate bad debts well. the entry to record a bad debt when it's reported uncollectible is a debit to the allowance or doubtful accounts and a credit to accounts receivable for the customer. So these are two asset accounts, right? You have a contra asset account and an asset account. So the reason it doesn't hit expense when you actually find out about it is because usually that's later after the period of the sale. But we've already recorded the expected expense in the period with our entry here. We recorded the bad debt expense in the period that it belongs in. So we don't have to record another expense. We just eliminate the accounts receivable. Okay, the other method is called the percentage of accounts receivable. At the end of the period, take the ending balance in accounts receivable and multiply by the estimate of bad debts expense percentage. So this time, instead of looking at how much we had in sales or credit sales, what we're going to do is say, how much are we owed at the end of the year or the end of the period? And based on that, make an estimate of how much that's going to be uncollectible and make our allowance account equal to that amount. The number generated should be the balance in the allowance for doubtful accounts. Keep this in mind when adjusting the allowance account. Because it may have a debit balance, which would make the entry larger than the number calculated. Let's just say you have a T account and you have the allowance for doubtful accounts. When you get that number, it should equal that ending balance. And so you have to determine the adjustment based on the current balance. So your entry is going to be a debit to bad debts expense and a credit to allowance for doubtful accounts. And then to write off an account would be a debit to allowance for doubtful accounts and a credit to accounts receivable. Any questions there so far? I'll leave that up for another minute, let everybody catch up, and then we'll jump to example 2. If you are already ready, take a look at example 2. Okay. So we have Fogley's Coffee Company, and it reports the following results for calendar year. Cash sales, 900,000, credit sales, 300,000. Its year-end unadjusted trial balance shows the following items. Accounts receivable, 125,000 debit. Allowance for doubtful accounts has a $5,000 debit. So when we draw up that T account, or not, we stole all the markers. Down here. You can put this at the bottom. And so right now, it's got a $5,000 balance. Okay, so just keep that in mind. Leave that at the bottom. And you can make yours a neater T account. Okay, and so let's look at part A. It says prepare the adjusting entry to record the bad debts expense assuming uncollectibles are estimated to be 3% of credit sales. So what we would do is we would record bad debts expense. And we would take the credit sales, 300,000, and we would multiply it by 0.03. Now, how do they get the 0.03? Based on their past history, based on what they expect going forward. And you really should look through your accounts receivable and just make sure there's nothing in there that's getting old that's going to really surprise you. Because accounts receivable has aging, and so you know how far out that payment is. And if you have a big one that's out there further, you may need to make another adjustment, but this is how they come up with it from past experience and then looking at current trends. So that's $9,000. And then a credit to allowance for doubtful accounts. And that's $9,000. Any questions on A? Go ahead. It is supposed to have a normal credit balance, but if you underestimate your bad debts, then during the year, as you write them off, it'll end up with a debit balance. And so you'll have to make that adjustment. Correct. And that's why I put that account down at the bottom so that we could kind of illustrate it and talk about it. Okay. So what you would do now is if you went in here, you would put 9,000 in here, and then the ending balance would be 4,000. Now you don't have to put this in yet because it's not really coming to fruition in this one unless you want to call this like A and then put a little line in there and do B and C. But C is the important one for understanding this because it doesn't matter what the balance is in doing it with the sales method. It matters with the percentage AR because it's going to affect your number. But in that first instance, if we put that in there, it would just be $9,000 credit and you'd have a $4,000 ending balance. Now, part B says, prepare the adjusting entry to record bad debts expense, assuming uncollectibles are estimated at 1% of total sales. So the entry is going to be the same accounts, bad debts expense, except this time we have to add the total sales, which gives us 1.2 million, and we're going to multiply it by 0.01. And that's going to give us $12,000. And then credit allowance for doubtful accounts. Or 12,000. And then again, we would come down here, we would put the 12,000 in here. And then our ending balance would be 7,000. Bless you. Oh, great. Okay, so that's how that would go for both of those. Now C says, prepare the adjusting entry to record bad debts expense, assuming uncollectibles are estimated to be 6% of year-end accounts receivable. So our year-end AR balance equals 125,000. Our estimated bad debts expense percentage equals 0.06. And so our allowance ending balance should equal, and it's 7,500. So here now, we say, okay, the entry is supposed to, or we're supposed to get to a 7,500 ending balance. Well, we have a 5,000 debit balance, so we have to add it to the 7,500, and our adjustment is 12,500. So our entry would be a debit to bad debts expense for 12,500 and a credit to allowance for doubtful accounts for 12,500. So let's say we roll forward to the next year. And you don't have to write this down, it's just going to illustrate it. So this is how we would start off the next year, right? Because we have the 7,500 was the ending balance. And so let's say we have a year like the pandemic. We start writing off accounts, and that's how we get to the $5,000 balance on the other side. So we write off Adams, 3,000, write off General Foods, 8,000. And then all of a sudden, now the current balance is going to equal 3,500 on the debit side. So that's how, if you do a poor job of estimating your debts, you end up with a debit balance from things that happened during the period. Does that make sense? Any questions? Okay, now we've got a practice for you. Number 3 and number 4. We'll just do number 3, do the first part, and then we'll go over it. They estimate about 15 minutes on the problem in total, so we'll check back on this one in about 5 minutes, and then we'll talk about number 2, and we'll give you time to do that one, okay? You guys can talk. This isn't a test or a quiz or anything like that. I have to walk out to the printer real quick. It was out of paper this morning, so hopefully I got what you guys need for the next chapter. My microphone's on the desk there, so FYI. If you have any questions, please let me know. Raise your hand. I'll be more than happy to come help. Okay, so let's go ahead and just look at the first one. So it says, prepare the December 31st year-end adjusting entry for uncollectibles. And it says that it bases it on 1.5% of accounts receivable. So we have the ending balance in accounts receivable. That equals 99,000, which we're going to multiply by 0.015. And that's going to give us 1,485. So on the 31st, we record bad debts expense. And then we record allowance for doubtful accounts. Now it tells us that the allowance for doubtful accounts has a $600 credit balance. We want that to equal, so we want the ending balance to be 1,485. It's already at 600. So the amount is 885. And so we have a debit for 885 and a credit for 885. Now in part two, we still want the ending balance to equal 1,485. The question is, how do we get there? And so I'll give you like a minute to think about that one. Okay, so it has a debit balance of 300. And so we add 1,485 plus 300. And our adjustment is 1,785. Now, they didn't ask for the entry, but it would be a debit to bad debts expense for 1,785 and a credit to allowance for doubtful accounts for 1,785. Now you have practice number 4 before we jump on to, I think that's section 4, not section 3, but track. And so you guys take about 3 minutes and do that one.